you get increased output, market wasn't really expecting it, OPEC Plus stays together, and the oil price goes up. I don't get it. Explain it to me.
It doesn't really materially change anything. When we think about what they did, they compressed 3 production hikes into 2 months. So it doesn't really change the terminal level of production. And the market tried to price in a much bigger terminal level of production over the last several days. And so what you're doing is you're getting a rebound rally back to levels where we were before a lot of these rumors hit. I think the key message here is that as you distribute potential Russian supply across other members of OPEC, they can't even hit their quota right now. So they're already significantly constrained in their ability to increase, with the exception of Saudi Arabia and UAE. And so when we think about how does this change the fundamental picture when we go to September, October, it really doesn't do anything, and that's why the market's rallying.
Okay, I mean, does good to see you, Jeff. Does more oil more quickly not make any difference, I suppose, at the margin, or the symbolism of OPEC Plus doing something different from what they'd originally planned, even if it's just different by calendar date? Does that make any difference at all in terms of the sentiment around oil?
It probably means an extra 100,000 barrels per day during the months of July and August, which is in a 100 million barrel per day per day market is minimal. But I think the concerns around the disintegration of OPEC Plus and so forth, I think a lot of those worries can be dismissed at this point in time, and that the market is still being well managed. And the one thing about this group is they're very transparent and very data dependent. And so if the market changes, the bottom line, this market was in a surplus during the months of April and May. The hit out of China was a recession to oil and all commodities. Remember, China was at the margin the biggest consumer, and it contracted materially during April and May, and as a result, inventories built. So, is this market in a shortage position today? No, but is it likely to be as we look out towards the end of this year? Yes.
Jeff, let's talk about the demand side for just a second. I was talking to Ed Morris of Citi earlier in the week, and he was much more pessimistic on demand going forward. And he thought that fair value for oil was more in the 70s. Make your case for the fair value in terms of the supply and demand picture.
Well, I think, first of all, let's look at the level of inflation, not only across the global economy, but within the oil sector itself. The cost structure is moving up $80, $90 a barrel. So if you're even talking about where a new equilibrium is, it's much higher today and rate rising by the minute. But I think when we talk about the outlook going forward, let's point out, this market was dealing with a commodity recession in the form of what China was contracting due to the lockdowns in Shanghai and the surrounding areas during April and May. Global oil demand contracted by 2.5 million barrels per day. What does the outlook look like going forward? China's coming out of lockdowns right now, and they're stimulating. So you can think about China's got one foot on the brake, the other one on the accelerator, and is about to take the foot off the brake. Then we throw on top of that a very strong travel season. People haven't gone on holiday for 2.5 years. You can already see it in plane bookings and bookings throughout, driving and everything else. And then finally, you have Russian production materially getting tighter over the coming months. So you put it all together, this market is going to get significantly tighter as we look out towards the summer months. Our target is still $125 a barrel, but there's a lot of risk to the upside.
A lot of risk to the upside, and gets tighter over the summer. But how long does that positive influence, Jeff, come from China? Because, yes, China is opening up in various places, but, maybe only until they shut down again. How sure can you be that we are on a course that looks more positive from an economic sense for China?
Oh, by the way, that is always a risk that that they lock down again. But I do want to emphasize that they're shifting their focus towards more testing. The economic implications and the civil unrest that the significant lockdowns on Shanghai created means they're unlikely to repeat that again. Maybe you could see, right now we would put demand down somewhere around 1 million barrels per day relative to the 2.5. You could see that not coming back in your rolling lockdowns. But the reality of us going back to another 2.5 million barrel per day demand loss is extremely unlikely. Let's look at the PMIs were the worst since February 2020, and metals demand was down 10%. I don't think we're going to see a repeat of that. And then you look at the amount of stimulus in the system. You have the party Congress in October. They're going to want to see growth going into that. It may not reach the targets people want, but there's going to be a lot of acceleration out of China between now and the autumn.
Which kind of begs the question, Jeff. Like, it's great if OPEC Plus is going to increase their quota, but like you said, they're just bringing forward that supply. What part of the oil market is the tightest? Like, what product or what grade of oil? Like, where are we going to see the biggest stress?
I think that is the right question to be asking, Alex, because when we look at refining capacity, we're short refining capacity, and that's one of the points that the OPEC member states make is this is not about oil production itself, but about the refining capacity to process that oil production. You look at jet fuel was trading near $300 a barrel. Distillate went off the board last month somewhere around $220 a barrel. You look at where we're trading right now. Given where the cracks are, we're trading an equivalent of $140 a barrel, and it's the entire across the board. And the parts where we're really short are the heavier, medium sour grade crudes, and things like shale don't produce a lot of middle distillates in jet fuel. They're not going to solve the problem, because those are those medium sour crudes like Russia produces are the ones that we're short relative to the quality of the refining capacity. But let's not dismiss the lack of refining capacity out there. The U.S. has shut 1.2 million barrels per day refining capacity over the last several years, and then you also have big maintenance programs.
So, Jeff, does that limit the ability of the Biden administration when it visits Saudi Arabia to call for more production once again on top of what we've heard today?
Yeah, absolutely. And I know the response back from Saudi Arabia, we can do what we can on the oil production side, but there's a refining capacity problem. By the way, this is the revenge of the old economy. It's not just refining capacity, it's everything in the old economy. Metals, mining, all of these sectors are underinvested and don't have significant capacity. There's a view that you're going to resolve all of these supply chain bottlenecks, mysteriously. The reality is it requires investment, and it's capital we're not seeing going to any of these sectors right now. People still do not like the old economy.